welcome to the Greater Texas Podcast. This is a podcast about building a better Texas. As Texas has fantastic growth, we, on a monthly basis, will interview a leader from the area and talk about what that growth means and how it affects us. I'm Sean Bukowski. I'm the principal of Bukowski Law Firm, where we protect your commercial real estate assets from dirt to disposition. Today our guest is my longtime friend, Scott Studzinski. He is the principal and the head of the Cressa office here in Austin, Texas, which is a commercial real estate brokerage firm. They look at all types of assets, and we have a great conversation really about the office market here in Texas and Central Texas and what it looks like for the future. So hope you enjoy it. Welcome to the latest episode of the Greater Texas Podcast, and we have a fantastic guest this month. Thank you to my longtime friend and buddy and business partner, Scott Studzinski. Thank you for being here, a partner at Cressa. Really appreciate you being here.
Thank you, Sean. It's been a long time coming, and my apologies for not listening to all 82 of your episodes before this one, but
well,
hopefully
you'd be better educated, I'll tell you that right now.
Well, lucky for me, I get to talk to you pretty much three, 4 times a week as it is, so
right,
I feel like
exactly.
I'm almost caught up. So
you're
great.
Very lucky for that. That's true.
I am very lucky.
All right, well, let's start with some background. So, Scott, you are originally from Michigan, right?
That's right, Sean. I'm from Detroit, Michigan, actually the city of Detroit, and I get a lot of questions about my neighborhood and what that was like. But so I grew up in Detroit, but luckily my parents sent me to schools in Grosse Pointe and Warren, Michigan for elementary and high school.
Which is shockingly where we met a long, long time ago at De La Salle High School, right?
That's right. Go Pilots. That was a lot of fun.
Right. Exactly. And then, well, let's talk about your fantastic university and what they have done recently.
I love how you throw me these softballs. This is great. So I don't, when we were at school, we were winning, final or, the Final Four in hockey, the Frozen Four, and we had a lot of great teams. Our softball team was great. Our football team was winning. And then, it's easy to assume that's going to go on indefinitely. And then, of course, as we all know, it didn't. And we're just happy to be back in the mix nationally. And by the time Jim Harbaugh got us to the top, he was ready to eject. And so I guess we're all sort of waiting to see how we do without him. But it was a great run, and we're all super excited for the success we've had.
Yeah, and I think that even if it is a little step back for us Michigan guys, the joy of that national championship will last a few years.
I mean, some folks go their entire lives, right? And then some programs almost get to the top. Oregon, and there's a few others, and then just never reach it, and their time passes. And so it was really sort of a pinnacle of my adult life was watching them win the national championship. So, and actually being there for it this time around.
That's
so
right.
It was awesome.
So then after you left the University of Michigan, you headed out west, right?
I did. So I was sort of looking to get out of Detroit, and I had a couple of job offers. One in South Carolina working for Rockwell, and one was at this fab startup in just northeast of Portland, Oregon, in Camas, Washington. And it was, they hired 20 manufacturing engineers to go over to Taiwan and train in the fab, and then sort of bring over that technology. And then we were constructing a fab, which took several years, as you can imagine. So we had time to sort of learn the tools and hire the operators. And then so I ran a portion of the fab for a long time, and it was a JV venture. And it turns out that our JV partner was a little company called Taiwan Semiconductor, TSMC, which is the largest chip manufacturer in the world. And so we got in on the early ground floor of that company and watched it grow and become sort of a world leader in what they did. And spent 6 years of my career there. I met my wife in Portland, had children in Portland, and then decided one day I was tired of wearing the clean room smocks, and I didn't think there'd ever be another fab built in the U.S. because back then they were billions of dollars to construct, and then another $800 million to bring equipment over. And I just didn't think at the time there would be any more fabs. And, quite frankly, I was correct for 10 years. And then all of a sudden, we're now back in this semiconductor fab boom that's now been back non-shored into the US. So I left that career and decided to attend the University of Texas MBA program here in Austin. And it brought us south. And that's how I got to Austin, Texas.
Oh, that was fortunate, and you loved it. So you went to UTMBA, right?
I did. So that was a wonderful experience. I met a lot of great people. I have friends, 20 years later from the program. My corporate finance professor was a funny guy named Jay Hartzell who took over the real estate department in real estate finance and got that sort of off the ground, and then became the dean of the business school, and then now that guy's running the whole university. He's the president of the university. So he made some pretty key hires in the football program and brought us to the SEC, and I'm just super proud of all the things that Jay's done for the University of Texas. And he's a real estate guy at heart, and so watching what happened with the Moody Center and the medical school and
the new hospital's going
into the new hospital as well. So he's been busy, to say the least.
Now, was he the one who got you interested in real estate, or did you know when you went to UT that you wanted to get into real estate?
Well, I had a little success in Portland. I was, tired of the boom and bust of the tech stock market, and I started dabbling and reading a bunch of these real estate investment books, and I ended up buying myself a duplex, which was a bit of a nightmare because there was always one tenant that wouldn't pay, and I bought it at the right time, and then we moved here, and I went to business school, and then I was sort of broke and in debt from school, and I sold it, and almost like doubled my money, and paid for business school. So that was my first experience in investing in real estate, and getting really lucky, of course, by the way, because I didn't know what the hell I was doing. So, buy low, sell high. It seemed to work. So I'm like, okay, I think I could do this. And then I did my first real estate classes at UT. I met some really great people in the program, and Prologis, which is the largest industrial REIT, recruited pretty heavily at business schools, Harvard and Texas being one. I guess there are a lot of alum at Prologis, and so they hired 6 or 7 of us right out of business school. And to this day, I'm probably friends with half those folks. They all have really great positions at no longer Prologis, but other companies. And so, it was a really great experience. And Prologis was a lot of fun. It was a lot of transactional experience, leasing, understanding markets and submarkets and absorption and where rates were going and how different owners viewed those investments. And so it was a really good experience for me. And then luckily a position opened up in Austin. So I got to leave Dallas after a couple of years and move my small little family back to Austin. So that was how I got back to Austin.
Awesome. And you've been doing since then some form of commercial brokerage since then, right?
Yeah, it sort of didn't start out as brokerage. It started out as, operating real estate. So Prologis is an operator and an owner and a developer. And so I was running the small little Austin office, which is, it's property management, asset management. You're putting together leasing assumptions and running a portfolio is really what that is. But just through the transactions, Prologis had call it a merger. They got acquired by a competitor during 2011, coming right out of sort of the market crash of 08, 09, and then that allowed me to sort of roll over to more of a pure brokerage role at a Austin boutique company called Live Oak Gottesman. And so then at that point I was doing leasing and full-blown brokerage, running around doing representing buyers and sellers and of commercial investment properties, and that role progressed to the point where I was sort of helping run the investments team, where we were looking for assets to buy and repurpose. And so that was a really, really great experience for me anyway.
Awesome. All right, well, let's transition and talk a little bit about what you're doing now. First of all, you're the head and principal over at Cressa, right?
That's right. Yeah, that's perfect. So I had 11, 12 years on the industrial landlord side of the business. operated asset classes, some retail, some office as well. And then, it became clear to me in the mid 2000 teens, 15, 16, 17, that, the office market downtown Austin was booming. Like every big tech company from Amazon to Facebook to Google had a presence in Austin, and that presence was growing. Apple being pretty much one of the largest, and then Oracle, of course, moving their headquarters to Austin. So I was looking at the industrial rents and the size of that portfolio, and I was, scratching my head trying to figure out how I was going to make a living doing industrial in 2015, 16, 17. And I was attracted to this little boutique-ish sort of tech-savvy, tech-enabled tenant advisory shop. And so I worked with these guys at a shop that represented a lot of the tech entrepreneurs here in town. And so that was really attractive to me because I'm used to driving in truck courts and industrial parks, and I'm always on the periphery or the bad neighborhoods of the city. I'm never in the cool neighborhoods. I'm never downtown. This job sort of allowed me to sort of get to know the downtown CBD market, get in front of entrepreneurs, and we were doing some really neat things. And so that's sort of when I jumped the fence from the landlord side of the business to the tenant advisory side. And those companies have sort of progressed from the original one and morphed into another company called Elevate Growth Partners, and then was acquired by Cressa. So what's unique about Cressa is a privately held, broker-owned shop based out of Chicago. It's very large, with 50 offices in North America. But the whole premise, the whole thesis is to sort of be the best in class at servicing occupiers and tenants. And so, we don't have signs on buildings like the bigger JLLs, CBs of the world, and we don't have Wall Street pressure of, having to cut divisions and lay off a bunch of people because we don't have that many people to begin with. So we're pretty lean, and all of our technology and all of our services are tailored to making the occupier, the tenant, help them make great decisions on their portfolio and in their real estate. And so our clients, range from, Pepsi and Frito-Lay to 3M. And then, of course, we still run around with local law firms and SaaS software companies and robotics companies. So we get the best of both worlds. We get to sort of work on the corporate advisory with big Fortune 500 companies, but then, we still feel like we're part of the cool kid crowd with the tech innovators and entrepreneurs here in Austin.
Awesome. Well, in addition to that, you have a company you run with a handsome young fellow. Tell us about MoonTower.
Yes. So, my friend Sean Bukowski and I reconnected after living in Austin, and we liked our day jobs, but we knew we weren't going to get rich, running around doing legal work and brokerage. So, we thought long and hard about what asset classes we knew and, where the opportunities were. I feel pretty comfortable touching every asset or investing in every asset class. But at the time, it was 2016, 2017, when we started looking for apartments. We had the resources and people around us that could sort of help us with our first couple of deals. We sort of knew how to do it, but it was a new asset class to me. And of course, you've had quite a bit of experience in it. And so it felt like that was the right time and the right asset class to sort of take that step and that leap forward. And, we bought some apartments in San Marcos, and we found the right contractor, we found the right property manager, and it couldn't have been a better transaction. And looking back, I'm like, wow, that was really easy. Really great. I wish every deal was like that, but unfortunately they haven't been. But it was right time, right team, and then right exit. And so that deal sort of whet our appetite. And since then we've done a couple of more multifamily deals as the general partner. And then of course, times got a little more difficult, and it became very difficult to make sense of cap rates and how do you buy this asset and what levers can you pull to create value. It became difficult with
You're trying to buy 1960s assets
Right.
at four
That's
caps or
right. That's
something,
right.
right? You know, it
After
just
the rents have already been run up for 4 or 5 or 6 years, it's like at some point they can't run up forever. Like where's this going to end? And so, you know, I'd stand here and say proudly, like some of the best real estate decisions we made were to not do some of the deals we were looking at, not the ones we did do, but the ones we could have done and didn't do. And we sort of exercised restraint. And when it didn't make sense to us, we walked away. And that happened a number of times where we were actually under contract and just couldn't make it make sense. And so, I'm equally proud of those deals as I am for the ones we've actually did.
yeah, no, I agree. I mean, it was such a crazy time and all around, especially in Central Texas, and the fact that we, I guess if we were a little looser and closed more deals, maybe we would have had a few more home runs, but we also would have lost some deals too, and gone awry for our investors, and so that was important to us.
Absolutely, especially on the first few deals. Like you're the caretakers of these people's hard-earned money, and it's not just people; these are your friends and family members. And
Right.
you're trying to prove something to them as well as yourself, and you got to be slow and methodical and thoughtful when you're using other people's money. And I think we have been, which is something I think is may differentiate us from others.
And then last year and a half ago, MoonTower kind of made a switch on sort of what it was at least focused on for the time being. And can you talk about that?
Sure. And again, we got to the point where we couldn't make value add deals work. Office was on fire, but also very expensive. Industrial asset values had increased dramatically. And so, I was looking around and I sort of had this epiphany. It's like, hey, listen, like we know everybody collectively between you and I and Matt. Like, why are we why are we working so hard to go find deals? There are folks already finding deals. Let's just participate with the guys we like and trust, that have track records. Let's bet on the companies we feel can deliver and execute and manage the risks the best. And so that's what we did. I think we made 3 of those bets this past year, and I'm hoping we can make another 2 or 3 bets this year. And I think it's really about understanding, the investment thesis of your GP partners and developers, and how good are they at managing the risks that they see and maybe some that they don't. And we're going to be cutting checks of our own along with our partners, and we think we're pretty good at picking winners. And so I guess we'll see.
Yeah, I think it was a real good opportunity to sort of switch our focus and become these LP investors and really get into, like you said, with some good partners, and maybe down the line as the market just continues to change, that new opportunities present itself and we do something else. But for now, I think this is a good area.
I do too. And when office opportunities come about, I mean, we've talked about Austin and the fact that its population doubles every 20 years. And office is sort of the ugly stepchild today, but there's going to be opportunities where you're now betting on just a low basis. If you can buy office for less than industrial, like how does that make sense, right? Because it costs 2 to 3x today, in terms of replacement cost. So if you can get an office building in an area that will sort of swing back out of this sort of mini office recession, then we may just want to go in and buy something all cash or all equity and just bet on Austin. Bet on the locations, bet on Austin sort of recovering faster than most cities, and it usually does. Even during coming out of COVID, you had occupancies in downtown Austin were 60%, which is low, but it actually led the country for a while in terms of just the number of people and bodies back in buildings. And so, I don't know if this hybrid model is here to stay forever. It's here for now, and it feels like there's a employer stabilization and Mexican standoff right now.
And that's a really good point to transition into sort of what we're seeing out there in the market now. And and also we talk a lot about housing, and obviously I've talked a lot about on this podcast with different people about housing because it's a real issue in Austin, and obviously you're familiar with that. But I also want to talk to you about an area where you are out there every day, and that's what you're just talking about, which is the office market. And so, what are you seeing now? If you're a tenant, is it a tenant's market out there? Is there a lot of vacancy? What's the sort of gist that you get when you go out there?
Sure. I would say that groups are flocking to the A trophy buildings for sure. There's a flight to quality. You hear that all the time. It's a popular catchphrase. And groups are shrinking their footprints. And so law firms, accounting firms that maybe couldn't afford, Six and Quad or Indeed Tower can now afford to go there. And so, I definitely think there's concessions to be had from the developers and landlords, and I will tell you that landlords, generally speaking, will give you a lot of free rent, but they're doing everything they can to sort of hold the face rates of the rents up, right? Because you get too far down, you're probably breaking some lender covenant, or you need lender approval to go below your pro forma. And so, they're sort of solving for, a debt coverage ratio. And if your face rents are below that number, you need special approval to do that. So they'd much rather give you TI dollars and free rent and try and do everything they can to sort of propel or prop up those face rates. And so you're seeing that, the older assets sort of on the periphery of the city, I suspect there's less leverage on those, but I don't know that to be the case. They'll do whatever they can or whatever they have to do to put bodies in those office buildings. But the CBD stuff and the domain product is always going to be pretty popular, and folks will flock to those assets if given the opportunity to. They just may not do it with the same square footage. A lot of groups across the board are dropping their footprints.
You're right. Are you seeing a lot of subleases out there? Are there a lot of people looking to sublease some places they have?
Yeah, I mean, it's all over the country. Obviously, in Austin, we've got 5.86 million square feet of sublease space. Not a ton of it downtown, except for maybe the Meta Facebook building.
I was just gonna say, what about the Meta and Google? Like, is that stuff on the market right now?
Meta is, and when I talk to those listing brokers at Cushman or the sublisting brokers, I mean, they're saying there's lots of activity, a lot of professional service companies. But last we talked, there was no leases signed yet. But that building will fill up. I'm more worried about the big blocks of space on North 183. Call it 290 North Mopac. That stuff is B, C locations, B, C product. That might take years and years, 3, 4, or 5 years to sort of get back to those assets stabilizing. The nice assets in the well-located areas with walkable amenities, that stuff will probably all fill up in the next 2, 3, 4 years, be my guess. And then you have another 6 million square feet under construction, right? And so you have some of the tallest buildings, Republic, and then you have Republic Square, and then you have, the Water Line, which is the big tower on, call it Cesar Chavez near Rainey Street. And those are tall buildings going up.
Right.
And so we'll see how that sort of plays out. But again, you're going to get some of the best banks and law firms gobbling up that space. And so we'll sort of see we'll see where the vacancy and the donut holes are later, right? Where it's just empty floors in Class B buildings.
Based on what you say, it sounds like you think that, like, especially the BC stuff in the BC areas could be in trouble. Do you see that those are opportunities for buyers to come in and potentially buy something up as those are distressed assets?
I do, but like you're going to rifle shoot location, right? Like I'm not going. You could give me an office building for free on 290 and Cameron Road. I'm probably not going to take it, like because you gotta you gotta be in an area, a trade area where there's going to be a lot of demand, and then you're going to have a velocity of deals that you can fill your buildings up with. Like so you got to really be careful where you go. And I guess this is probably true with every city and submarket is, you don't have to go sometimes very far, 2 or 3, 4 blocks, and be in the wrong neighborhood. So you got to be careful what you're buying. But I'm a buyer for stuff way below replacement costs on the west side of, call it Lamar, like anywhere along Mopac or 360 or Southwest Parkway. I think that stuff's going to outperform the other stuff. Call it North 183, North Mopac. I just think that product has a lot of desire, and they're not very old buildings, and the amenities aren't very far, and you get good value in that stuff.
We talked a minute ago about how you're seeing companies downsize and the amount of office space they had. Obviously, it's all COVID and work from home and all that. Do you see that continuing, or do you think that's going to sort of slow and people are going to want more office space, or how do you think that will work?
That's $1 million question, isn't it?
Right. Yeah, it is. If we had that answer, we'd be, whatever.
I'd say that for the foreseeable future, I think we're here to stay with this. Hey, everyone, let's give employees the freedom to work from home or hybrid 2 or 3 days a week. Is that sustainable for the next 10, 15, 20 years? I don't know. I guess it sort of becomes unemployment rate related, right? Like if unemployment's 5, 6, 7%, and employers have all the power, they're going to make the rules, and hybrid work's going to evaporate. If they don't, and we're still sub 4, like there's a balance, right, between labor and the leverage labor has versus the employer. I don't foresee that unemployment rate skyrocketing anytime soon. We have a shortage of labor that hasn't remedied itself. We have a wonky immigration policy that hasn't remedied itself, nor has Congress remedied it. We have, birth rates have dropped. We have, there's all kinds of demographic shifts that have happened, and we might be shortage of labor for the next decade, maybe longer, right? Until we solve that or figure out a way to, thoughtfully bring in the sort of immigrants that come and go to our universities and start companies. Until we solve that, I don't know. I really don't know how we're going to get enough people here to sort of support the 330 million folks that are already here. And of course, we have the baby boomer demographic near or at retirement, and we have this young generation of folks who, a lot of them, 40% of kids under the age of 30 are still living at home with their parents, even if they're college graduates. It's just a weird time in history. And the normal models, the economic models, don't seem to apply or make sense when you have these other variables at play.
Yeah. Well, the flip side, I guess, for this area is that at least recently, we're still seeing companies and businesses move here to the Central Texas area, and thus, I think I've heard you say this before, we can grow out of it, right? And there's at least some hope for that.
Absolutely. Like we're still, Texas and Austin specifically, we're the 11th largest economy in the world or something, if we were a country. And it doesn't seem to be slowing down. If you talk to the folks that run Opportunity Austin, there's still well over 100 companies looking to make big investments here, between, Tesla growing and increasing their number of hires. And of course, Samsung having two fabs under construction now, and with permits for another, 7. Like this train could keep on going for a very, very, very long time. It's amazing to even witness. And so, you're right. Like you can make pro forma mistakes, and hopefully, our immigration and our population growth bails you out. So, I'd bet on Austin, and I have, and I will continue to bet on Austin and Texas.
And I wanted to ask you a little bit about when we're talking about the sort of, again, back to the BC office and that kind of thing. Have you found any good ways to repurpose those office buildings. I know everybody I talk to on the multifamily front says, the utilities are too expensive, and it just doesn't work well. I've talked to, maybe some medical office or something like that, so kind of curious what you've seen.
I mean, I think you have to have the right floor plates, right? 'Cause nobody wants an apartment in a closet without natural sunlight. And so the floor plates have to work or be shallow enough so that you can build apartments, around an elevator core or a restroom core. What I've seen in happen, I've read this, is that there are some groups in New York that will lose square footage. They'll build a corridor around a floor plate and you'll lose square footage, but then it enables the depth and length to now create apartments where you still have natural sunlight for all the apartments. And so, if an owner is willing to just sort of throw square footage out the window and not calculate it, and just sort of build this box core around it, and then you could do it, right? Like, it's definitely doable, but it's not easy to do, and it's not nearly as inexpensive as you'd hope it to be. So I don't see that, unless it's like super high density areas where the land values are really high, like in Manhattan. Like, I don't see that happening all over the country. Just maybe in select markets and submarkets. I hear about it in Dallas, but I don't know how rampant that really is. It might just be, one or two really nice stories about it, but it's not happening all that frequently as far as I can tell.
And one other thing I'm curious about is whether you've seen when your clients are negotiating TI with the landlords, are the offices they're designing similar to the offices that we've been used to, where you have some offices and then you have some inner cubicles and that kind of thing, or is the design different now and based on what they want and what they need?
Well, it's funny. We have this like WeWork tech design that sort of spilled over into professional services, and all of a sudden attorneys are like in low, low cube desks, and quite frankly, it just doesn't work for every sort of industry, does it? I mean, I feel like I've been into tech company spaces where it's so loud. The sales team have screens and they're yelling, and then there's like developers, they're writing code, down the hall, and they like it dark, and they like their earphones in, and they're looking at bright screens and sucking down Mountain Dews, and like, this is very different. And so you got to be really thoughtful. But luckily, there's SaaS companies are SaaS companies. There's always a sales group, and there's always a development group, and there's everything in between. And so you started seeing, a lot of the same architectural firms designing the same sort of interiors. And let's be honest, like, it's a war over talent. Now you're just trying to get bodies into the office. And so you got to get super creative in how you do that. And some of it's finish out, making the offices cool and comfortable, and allow, people to be able to walk around and have outdoor space. And then, if you can keep them on the clock longer, then that's sort of money you're sort of stealing, or it's productivity you're sort of stealing. So the Googles and the Facebooks figured this out a long time ago, and now these other tech founders have sort of figured out, hey, if I feed them, or I give them cold brew or have a beer on tap, I might be able to get another hour or two out of some of these guys, and it seems to work. Seems to work, and certainly, if you want those people to come back into the office, you better have a compelling reason to do it, other than just, you better come into the office, right? Like, that works for a little while. It doesn't work forever.
Right. Well, despite all these sort of issues and obstacles or hurdles and that, you and Cressa and MoonTower are still very positive on the outlook of this area, Central Texas in general, right?
It's hard not to be. It really. I mean, most people that are here are happy to be here. They chose it. Like, you don't just happen to like end up in Austin. Like, it's not very easy to get to Austin. Like, Austin is south of the entire state of Arizona. If you look at a map, you're like, wait a minute, I'm south of El Paso? Yeah, you're south of El Paso. So you got to be sort of intentional if you come to Austin. And I think what happens is that those type of people that are here, the ones that are ambitious and fun and creative, and they like this town for all the reasons, the food and the music, it attracts like-minded folks, and I think you have a city where it's changing rapidly, so it's always new. Like, it doesn't feel like it's getting old and stale because new neighborhoods are popping up, new projects are popping up. I feel like it sort of keeps things fresh, and the restaurant scene's great, and so new things are making it more interesting and more attractive. And of course, we had Dell Match Play and Formula One, so now South by has been here forever.
Austin FC.
So people come to this town for a lot of different reasons now, and a lot of them end up staying, and it's hard to blame them because I was one of those people.
Well, thank you so much, Scott. Really appreciate it. Been a great guest. I really appreciate our conversation.
You've got it, Sean. It's too bad I'm like your 80th guest and not your first guest, but that's okay.
Well, maybe you'll have to listen to one now. And it'll be
That's
great.
right. I will. I'll listen to all of them.
Thank you very much.
You got it. Thank you, sir.
Thank you very much for listening to the latest episode of the Greater Texas Podcast. Hope you enjoyed that conversation. If you'd like to hear some of the other great conversations we've had on this podcast, please go to bukowskilawfirm.com. And when you're there, if you sign up for our weekly blog email, you'll be able to get updates to all of our latest podcasts. Otherwise, you can go anywhere that you watch or listen to your podcasts on a regular basis, and the Greater Texas Podcast is also uploaded there. Thank you very much.